Bollinger Bands, trading strategies and market entry points. Today, there are many different indicators available for trading in the financial markets. And new indicators appear periodically. But in many cases, these new indicators are just a variation of the classic versions. Today we will discuss one of the most reliable trading indicators that has stood the test of time. This is the Bollinger Band indicator. We will discuss the main components of this indicator, and I will introduce you to several profitable trading strategies. Many traders believe that using a large number of indicators will help them become more profitable in trading. But this approach does not work. Imagine the following situation. The price is above 20 mega amperes. The RSI indicator indicates overbought, while the ADX indicator shows that the market is not trending. Which of the three indicators will you follow? However, the Bollinger Band indicator will help you cope with most contradictory situations. What is the Bollinger Band indicator? The Bollinger Band indicator is a trend indicator consisting of 3 lines. It was created by John Bollinger in the 1980s. It can help you identify overbought or oversold areas, as well as determine the current market volatility. The Bollinger Band is best described as a volatility indicator. It consists of upper and lower bands that respond to changes in volatility. 2 bands cover the price movement in the upper and lower extreme values. When the volatility is high, the distance between the 2 bands will increase. When the volatility is low, the 2 bands start to contract. The indicator includes a standard 20-period simple moving average that can be used to set entry and exit points for trades. The average line is calculated by summing the closing prices of the last 20 periods, and then dividing the result by 20. The upper line is calculated using the 20-period SMA and the standard deviation. The lower band is calculated in the same way, using the 20-period SMA and its standard deviation. The default standard deviation is 2. Therefore, the Bollinger Band settings are usually expressed as: the upper line is calculated using the 20-period SMA and the standard deviation. The lower band is calculated in the same way, using the 20-period SMA and its standard deviation. The default standard deviation is 2. Therefore, the Bollinger Band settings are usually expressed as 22. What is the deviation phase? In practice, it means how far we are moving away from the average value. In other words, if the price is near the upper band, it is considered expensive, since it is at a distance of 2 standard phases from the moving average. If it is the lower Bollinger Band, it is considered cheap, because it is 2 standard phases below the MA. However, this does not mean that we should immediately open a deal. In a trending market, the price can be expensive or cheap for a long period of time. How to use the Bollinger Bands? Although it is primarily a volatility indicator, Bollinger Bands are quite useful for detecting support and resistance levels. There are several signals that can be generated using this indicator. These signals respond to different price relationships on the chart. Let's look at each of these signals. Band compression. When the Bollinger Bands are close together, the trading indicator tells us that the volatility is relatively low. So the trading volume is usually also low and the price is consolidating. This is what we call Bollinger Band compression, because the bands are tightly compressed together. In most cases, we should avoid trading in very narrow price ranges, as they provide significantly less profitable opportunities. An important concept is that the market will constantly move from periods of low volatility to periods of high volatility and back again. As you can see, after the compression, prices break down and enter a stable downtrend. The breakdown of the Bollinger Band compression provides a good prerequisite for entering the market when the price goes beyond one of the bands. This will provide support in favor of the fact that the market with a limited range is coming to an end, and the probability that the price will enter a new phase of the trend. The price touches the lower or upper band. This is the standard Bollinger Band signal, which indicates that the price is oversold in terms of volatility. As a result, a bullish rebound may occur, creating a long trading opportunity. Think of it as a hidden support level based on extreme volatility. However, if the price starts to fall rapidly in the lower band, and the distance between the two bands continues to increase, then we should be careful when entering a long trade. When the bands widen and we see strong price momentum below the lower band, this is a sign that the bearish bias is still relevant. The same scenario works, but in the opposite direction. We consider the upper band as a hidden resistance level based on extreme volatility readings. However, if the bands widen and the price starts to close above the upper band, then we expect a bull market. Breakdown of the moving average. The breakdown of the moving average of the Bollinger Bands is a confirmation signal that usually appears after the price interacts with the bands. If the price bounces off the upper band and then breaks through the 20-period SMA in a bearish direction, we get a strong short signal. If the price bounces off the lower band and breaks the 20-period SMA up, then we get a strong long signal. Thus, a 20-period SMA breakout can be used to set exit points after entering a trade on the Bollinger Bands. The Bollinger Bands sum up the signals we discussed. The circles indicate critical breakdowns of the 20-period simple moving average. The arrow indicates the compression of the Bollinger Bands. We can see the price dynamics at the breakdown of the lower Bollinger Band, and the green arrow shows the trends on the upper Bollinger Band. Bollinger Bands and candlestick patterns. One of the reliable trading strategies that use Bollinger Bands is a combination of Bollinger Bands and candlestick analysis. You can enter the market after the price touches the lower Bollinger Band and then closes on the reversal candle. And on the other hand, you can short when the price reaches the upper band and then forms a reversal candle. I prefer to close half of the trade when the price reaches the moving average of the Bollinger Bands. The reason for this is that candlestick patterns usually do not lead to large price reversals, but rather to shorter price movements in general. The arrow on the chart shows the compression of the Bollinger Band. The bands are relatively close to each other, compressing the price in the indicator. After that, the price starts to decline. Suddenly, the bands begin to expand rapidly during the descent. Soon we see how the price creates a pin bar. This is a strong bullish signal that occurs in the lower band, which creates a good buying opportunity. The stop loss should be placed below the lowest point of the pin bar, as shown in the figure. Then the price starts to rise. 6 periods later, the price breaks above the 20-period simple moving average of the Bollinger Band. 50% of the transaction can be closed. The price continues its rally. On the way up, we see several reversal candle patterns. However, they are not confirmed, and we ignore them as a potential exit point from the deal. At the end of the price increase, we see a doji reversal candle, followed by 2 large bearish candles. The closing of the second bearish candle can be considered the first exit from the trade. If you decide that this signal is not convincing enough, you can wait for the breakdown of the 20-period simple moving average, which will occur in 3 periods. Bollinger Bands and breakdown. In this strategy, we will consider the situation when the price goes beyond the upper or lower Bollinger Band. At the same time, the bands should expand, indicating higher volatility. In addition, we will enable the volume indicator to open trades only if the volumes are large enough or the price is moving in the direction of the trend. If all these requirements are met, we can open a trade in the direction of the breakdown. This tactic allows you to take advantage of the rapid price movements caused by high trading volumes and high volatility. You should always use a stop loss in this trade, and it should be located above the 20-period simple moving average. It will act as a trailing stop, which means that you will constantly adjust the stop in a bearish direction. According to our strategy, we should stay in the deal as long as the price is below the 20-period SMA. After we open a short position, the price begins to increase the intensity of its downward movement. The decline is sharp and continues for 6 days. Then it reaches its lowest point and begins to fluctuate after it. The range continues in the direction of the 20-period simple moving average, which soon breaks up.